What are economic and market indicators that can be used to evaluate the state of the business cycle? Not only reflecting the health of the economy, but also determining the current phase, like expansion, peak, contraction, or trough. Worth mentioning here already, these indicators are often lagging, coincidence, or leading indicators. Emphasis will be placed on this going forward. Furthermore, the subsequent article will comprise all the necessary links to follow up on. Alright then, what are the key economic indicators? Let's start with gross domestic product or GDP, which is usually a lagging indicator. It measures the overall economic output and growth. Increasing GDP signals expansion, while declining GDP indicates contraction. Next, unemployment data, which is also a lagging indicator. It includes non-farm payrolls, unemployment rates, and labor force participation. High employment suggests expansion, while rising unemployment signals a downturn. And complementary to employment data, the inflation rate, which is also a lagging indicator. It includes the Consumer Price Index, CPI, and Producer Price Index, PPI, as well as PCE, the personal consumption expenditure, which is the preferred indicator of the Fed. Rising inflation is typical near the peak of a cycle, while disinflation or deflation occurs in the recessions. As you will hear in one of the next lectures, the unemployment-inflation trade-off is crucial for central banking policy, leading us to interest rates, which is sometimes a lagging, sometimes a leading indicator. Short-term interest rates are controlled by central banks to manage growth and inflation. Rising rates may signal a late expansion, while falling rates often accompany a recession. It is important to distinguish between short-term and long-term interest rates, whereas the latter are determined by market participants, meaning the debt volume issued and the demand for that. This leads us to the yield curve, a steepening curve implying that long-term interest rates are increasing faster than short-term interest rates, signal growth, while inversion often precedes recessions. That implies the opposite of the previous statement, implying that short-term interest rates increase faster than the ones on the long end. No worries, we will get to that in more detail later in this course. What about corporate earnings? They reflect business profitability directly tied to economic activity. Strong earnings indicate economic growth, while shrinking profits suggest a downturn. Earnings affect business confidence, which is reflected in the Purchasing Managers' Index or PMI. This is a so-called leading indicator. It gauges manufacturing and service activity levels. A PMI above 50 indicates expansion, while below 50 it signals contraction. If businesses increase revenues, what about industrial production and capacity utilization? This indicator measures manufacturing activity and economic utilization of resources. Growth in these indicators signal expansion. A leading indicator to watch out is also housing markets data, implying that housing starts and existing home sales drive growth. It impacts consumer spending and employment. In line with that, strong housing data benefits home builders, real estate, and the materials sector. Weak housing markets align with broader economic contractions. After goods are produced and houses are built, what about the consumer? Common indicators revolve around consumer confidence and retail sales. Consumer confidence indicates public sentiment about the economy's future. Higher confidence suggests potential growth. Declining confidence hints at contraction. If we go back to the market indicators, why are currency trends of importance, or what dynamics are in play? The global risk sentiment and the trade dynamics. A strong domestic currency can hurt exports, but benefits consumers as they have a higher purchasing power. A weak currency boosts exports but increases import costs. And what about commodity prices, as they oftentimes serve as leading indicator? Rising commodity prices suggest strong demand and expansion. Falling prices indicate weak demand or deflationary pressures. However, if commodity prices like oil price shocks increase too fast, that might be even detrimental, as commodities are input factors in production.